Let me begin my series of just a couple brief questions. And this first one will be directed toward each member of the panel. Try to be brief and specific with your answer. Dodd-Frank, an appropriate reaction to the financial crisis, an overreaction, or a reaction that wasn't strong enough to the financial crisis? How would you answer that? Brief and specific. An appropriate reaction, an overreaction, or not a strong enough reaction? Let's start here and we'll work our way down.
Dodd-Frank's a mixed bag. There are many provisions that are, I think, an overreach, and there are some provisions that I think are very helpful, including deposit assessment reform and the assessment base that community banks and other banks are able to take advantage of, which are going to save us a whole lot of money and put the burden more appropriately where it needs to be. There are other provisions of Dodd-Frank that, frankly, scare us tremendously. The CFPB, while we have a bit of an exemption or a carve-out in community banks, we're still subject to their rule writing. Today, what we have to understand is we're already overburdened with regulation. We have a significant number of regs that we need to comply with today, and it seems like just one more isn't going to change the deck a whole lot. But the piling on and the consistent piling on of additional regulation is very, very stunning. In the good old days, I had a part-time person that did 10% of their job in the area of compliance, and we complied with all the rules of the land. Today, we've got 6 or 8 people, all senior officers, that sit on a compliance committee attempting to deal with these reforms as they come along, and it's punishing, and it's very difficult for small institutions.
Mr. Daley, an appropriate reaction, an overreaction? There you
go. Thank you. I think our members would say it's largely appropriate. The process in the Congress was fascinating to watch for us. And the balance that came through the debate and exchange it really served the country well, we think. There are a couple of areas where we'd like to see things stronger. The proprietary trading provisions we thought could be strengthened. We would have liked to see the swipe fee rules applied to credit cards as well as debit cards. But overall, the work of the Congress seemed appropriate. I also think it's appropriate for to continue your work now. Congressional oversight of the implementation of this act is important. It's good that you're holding the hearing here, and there are other hearings, because that balance that we think was achieved in the Congress needs to be achieved in the implementation of the act.
Mr. Sekula.
NAFTA does not blame Dodd-Frank for the credit crunch, but we do believe that it overreaches and is an overreaction. As all credit unions are under the CFPB's rulemaking authority. A couple items that we do like, we feel positive about the Dodd-Frank, of course, is, as mentioned earlier, the permanent increase in the federal deposit insurance from $100,000 to $250,000, and plus consumers do need protection from predatory lenders, and we understand and we support that view, and we're just hopeful that that more time will be spent on unregulated entities such as payday lenders, be the focus from the CFPB.
Mr. Boyle.
I feel that it's an overreaction. In our shop of $800 million bank, we have 2 full-time compliance officers, and we also outsource a third party to make sure we remain in compliance. We're anticipating, with the uncertainty that the Dodd-Frank bill is going to bring, that we are actually interviewing additional consulting firms that could cost us anywhere from $75,000 to $125,000 going forward to make sure we maintain our good standing in the compliance arena. So we feel that it's an overreaction.
Thanks. Mr. Daley, quick question, and I'm confused, and I apologize for that. Briefly describe your members to me, because I think if I took you by the hand and you and I walked around my district for a day and we talked to 50 small businessmen and women, you'd hear the same refrain. They're scared to death. There's so much uncertainty out there. And there's a lot of angst about the additional regulations and the regulatory climate that they believe Dodd-Frank is going to lead to. Your members are fine with what's coming?
May I describe our members? They are small businesses. We have about 10,000 members. Our members are the owners, and they own and operate their businesses. They are more, I talk to them a lot, we're in fairly constant communication. And they come here a lot to testify to Congress and go to meetings. They're more concerned about the long-term return to practices that put them in the tank. And when I have these conversations with our members, that's their greatest concern. They see the problems that were caused by these practices as having harmed them, as having destroyed their customer base, and that the law that's being put in place to prevent that from happening in the future is important.
Did they feel overregulated before Dodd-Frank?
When I talk to them about the operation of their businesses, they don't talk to me about regulation. They talk to me about what is going on in my community. My community is the quality of life and the quality of the local economy is what's important to them. They don't draw their business from around the state or around the country or internationally. They draw their business from their community. And their community is in trouble now, and their business is in trouble as a consequence. So they don't talk to me about regulation. They don't talk about taxes. They talk about getting investment into the community, getting jobs into the community, so that my business can continue to thrive.
Boy, you and I are talking to different folks. That's fascinating. It actually is. One final quick question, Mr. Ohlendorf. Are you getting consistent information from regulators about your portfolio?
I talk to a lot of bankers around the country, and we feel like there's some very inconsistent data. I talked to a banker on the way to the airport yesterday from one of our neighboring states who was dealing with an appraisal. And they had gotten the appraisal, you know, it's supposed to be the be-all, end-all, that this is the value of the property. And they were concerned about some of the assumptions. So they shared some of their thoughts on those assumptions with the appraiser or with the examiner. And the examiner came back and said that that bank had no business making any changes to the assumptions of the appraisal. Okay, fine. A banker 30 minutes from that bank had a set of examiners in and had a piece of commercial real estate that was worth, on their books, $4 million. It had just been appraised at $4 million. And the regulators came in and asked that bank to charge that loan down to $2 million because the appraisal wasn't worth anything. As a banker, and in trying to work in this economy, how am I supposed to take those two stories that are both very current, banks that are 30 minutes apart in a neighboring state, and gel that together to understand what I'm supposed to do to help, you know, make small business loans? I can't have arbitrary 50% write-downs to my portfolio when the appraisal just indicated that the value was what I said it was. And on the other hand, I can't look at another appraisal and try to, you know, say, well, maybe some of those assumptions aren't accurate and try to massage it because they were told they didn't have the credentials and the expertise.
Thank you.